Hi everyone, welcome to Impact Academy. So today let us continue with the economy question and answer session. So last session we have seen till 30 questions. So let us continue with 31st question. So which of the following organizations came up with the State of Inequality India report? Okay, so these reports are, very important. Frequently, different types of reports are released. So, State of Inequality in India is given by the Institute for Competitiveness. Okay, so the State of Inequality in India report has been written by the Institute for Competitiveness and presents a holistic analysis of the depth and nature of inequality in India. The report compiles information on inequities across sectors of health, education, household characteristics, and the labor market. So, remember these ones. What does this inequality report talk about? Health, okay, education, household characteristics, and labor market. So, such questions can be asked. Okay, what are the components? So, we've already seen in Human Development Index, right? Income and education, health, and all those things. So, three pillars. So, all these individual components are also very important. So in this case, it is health, education, household characteristics, and labor market. As the report presents, inequities in these sectors make the population more vulnerable and trigger a descent into multi-dimensional poverty. So we've already seen some questions on multi-dimensional poverty also, right? So that is also very important. And we've seen many statistics related to MDI. Okay. So this inequality report also shows how much inequality is there, and because of that, because of too much inequality between the rich and the poor, educated, uneducated, etc., there is a chance that we may slowly descend into multidimensional poverty. So, with reference to the non-banking financial company (NBFCs), okay. So, banking is also a very important part of economy. Frequently, questions will come. Uh, so NBFC, I'm sure already you are aware, non-banking financial company. So it is not a bank, but it takes up some banking activities. Okay, consider the following statements. It is a company registered under the Banking Regulation Act of 1949, engaged in the business of loans and advances. So if you take banking in general, so what does a bank do? One thing, it takes money from you, okay, and it even gives back money to the customers. So it takes your money in the form of your savings bank account or fixed deposits, your FDs, okay, your RDs, all these things. Basically, it takes money from you and it pays you interest of 6%. Then the same money it loans to other business people or whoever wants a loan at 10%, 20%, whatever percent. Usually, housing loans will be 10%. So from you, it takes at 6% and it is giving out at 10%. So that 4% is profit for the bank. Okay, so all its expenditure is met from that 4%. So approximately. So that is banking business. So a non-banking financial company, it does not take money from the public. Okay, that is why it is called a non-banking financial company. On the other hand, it is engaged in loans and advances. So advance is also is a kind of loan. Okay, it's a loan and advance, basically giving out money. And remember this point: giving loans is an asset for the bank. Okay, don't get confused. So whatever money you deposit in the savings account, that money bank has to give you back someday. So that is called a liability. Okay, but loans on the other hand, when you give a loan, it generates some interest. So that is the reason loans and advances are considered as assets. Okay, and savings deposit, money in the savings bank account, FDs, all these things are considered as liability because they have to pay it back at any point. And also there is one thing called as demand deposit. So for example, you have your savings bank account, you have 1,000 rupees. You can remove it whenever you want. You can go to ATM, you can use your ATM card and remove. So whenever you demand, you will get back your deposit. That's why they are called as demand deposits. So FDs and RDs you cannot remove like that, right? So they are not on demand. What is say liabilities anyway? So it includes any institution whose principal business is that of agriculture activity, industrial activity, purchase or sale of goods. So fine. So it can be loans to agriculture industry or for the purchase or sale of goods. All this is fine. So all NBFCs are entitled to accept public uh, so, see, all NBFCs are entitled to accept public deposits. So, as I already told you, the main difference between NBFC and non-NBFC is that it does not take money from the public. Okay, and also first one we have seen is the company registered under the Banking Regulation Act of 1949. That is also wrong. So we are talking about loans and advances, but in general, if you look at Banking Regulation Act of 1949, that's a very important act. So then, if you look at statement one, the non-banking company is registered under the Companies Act of 1956, not the Banking Act. Okay, all the scheduled commercial banks, okay, are State Bank of India, Punjab National Bank, ICICI, HDFC. All these are scheduled commercial banks. So some of them are they may be public or private, but they all come under the scheduled commercial banks. Okay, and they are under the Banking Regulation Act of 1949, which is very important. But NBFCs come under the Companies Act of 1956. Okay, and they are engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government, okay, etc. So they deal with all these kind of things. Okay, they don't take deposits. So statement three also is wrong. All NBFCs are not entitled to accept public deposits. Only those NBFCs which the Reserve Bank had given a specific authorization to hold public deposits, that to a limit of 1.5 times its net owned funds. Okay, so NBFCs usually do not accept public debt. They are only dealing with loans and advances. So one is wrong, three is wrong, second is also wrong. See, a non NBFC is a company that offers financial services similar to banks. These services can include hire purchase system where you hire goods with the option to buy. Insurance business can be there. Chit business can be there. Okay, all these chit funds, Margadasi chit funds, they're all non-banking financial companies. Okay, so however, NBFC does not include any institution whose main business is related to agriculture, industry, buying or selling goods, except securities, etc. Okay, so sale or purchase of construction. So this is more you can, I mean, NBFC is more about okay non-banking financial business, right? It is into financial business, but it is not a bank. It does not accept money from the people. So which of the following statements are incorrect? All three are incorrect. It is not banking regulation. It is Companies Act 1956, and it does not include institutions whose business is of agriculture activity. So if it is giving loans for purchase of agriculture tractors and all, that is a different thing. Okay, that's different. But it's not primarily involved in agriculture or industrial activity. Okay, it is into financial activity, not agriculture or industrial. And NBFCs are not entitled to accept public deposits. So which of the following are incorrect? One, two, and three. So consider the following statements. Fiscal deficit is the difference between government's total receipts and total expenditure. Yes, if you look at what is fiscal deficit, okay, what is deficit? Deficit means something which is less. So when you have certain expenditure and when you have certain revenue, if you are earning 1,000 rupees, so you have to spend 1,000 rupees. Okay, if you are earning 1,000 rupees, but you are spending 2,000 rupees, then obviously there is a deficit of 1,000 rupees. Okay, so when your expenditure is more than your income, then the revenue you are generating, that is called as deficit. When the balance of the government's total receipts, that is revenue plus capital receipts, and total expenditure, revenue plus capital expenditure or capital revenue, capital receipts, that deals with something related to creation of assets, etc. Okay, so building roads, okay, building, purchasing equipment, all that comes under capital expenditure. Revenue expenditure means paying salaries, paying interest. So you cannot see any result of it. So you pay salary, the money is gone. That's it. You cannot see any asset. Okay, you are just buying services or paying interest with revenue. It also to be negative. So it shows situation of fiscal deficit. So fiscal deficit is your expenditure is more than the revenue. So it shows that the government is spending beyond its means. Okay, fiscal deficit may be shown in the quantitative form, that is total currency value, or in the percentage form of GDP. Okay, if you look at if you study the budget documents, you can see fiscal deficit is 4.3%, 5.6%, or there is a 33,000 crores, etc. So it is one thing in the form of a direct value of currency or either percentage of GDP. So, second is the concept of budget deficit rather than fiscal deficit is widely used in the economy in the recent times. So, budget deficit is the difference between total budgeted expenditure and receipts that include the money borrowed from the market by the RBI by floating government securities. So, basically, whatever expenditure you are budgeting in the budget, okay, when you are planning the budget, whatever expenditure you have and what are the receipts that include, including the money borrowed from the market by the RBI. Okay, all these things. That is the difference between this expenditure and this receipt is called budget deficit. But this concept was discarded in 1997 as it led to accounting distortions. Okay, so because it was leading to some accounting problems in 1997 itself, this budget deficit, using the concept of budget deficit was discarded already. So it is not widely used. Monetized deficit refers to the purchase of government bonds by the central bank to finance the spending needs of the government. Okay, so if you look at the government has some deficit. That means it is getting 1,000 rupees, but it wants to spend 1,500 rupees. Okay, because it needs to pay salaries, it needs to give subsidies, it needs to create infrastructure. So it is saying it wants to have spend 500 rupees more than what. Then it will go to RBI because see RBI is the central bank. So for the government needs of the banking needs of the government will go to the RBI. Okay, that is why it is called as the central bank. So what RBI is doing is it is this 500 rupees it needs to arrange for the government, right? Because you have only 1,000 rupees, but the government wants to spend 500 1,500 rupees. So RBI will say, okay, I will give you the securities or bonds for everyone because RBI and central government are very reputable organizations. People will come and buy those bonds, and you will get the 500 rupees, and that 500 rupees RBI will give to the government. Okay, so now the government is monetizing the deficit of the central government, right? The central government is having 500 rupees deficit. So RBI is giving bonds or securities and arranging that 500 rupees. So it is monetizing the deficit. Okay. So it refers to the purchase of the government bonds by the central bank to finance the spending needs of the government. Okay. Also known as debt monetization. This is only known as debt monetization. The exercise leads to an increase in total money supply in the system because where there should be 1,000 rupees, now there is 1,500 rupees. So there is more money supply in the system, and inflation will increase because you have 1,500 rupees. You are going to spend more. The government is going to government banks are going to give more loans. Okay, government is going to give subsidies. People are going to have more money in their hand. So inflation is going to reduce because previously you had 100 rupees, so you're not willing to purchase an item worth say a soap for 30 rupees. But now if the government has more money in the system, and instead of 100 rupees you have 1,000 rupees in your hand, previously that 30 rupees soap used to look very pricey. Okay, but now you have 1,000 rupees in your hand, so 30 rupees soap is not a big deal for you. You will buy the soap. So that is how inflation is increasing. As RBI creates fresh money to purchase the bonds, same bonds are later used to bring down inflation as they are sold in the open market. Okay, so later the same bonds will be again sold in the open market. So when they are sold in the open market, the public will go and buy it. Okay, when the public goes and buy, you will have to buy from your own money. You have 1,000 rupees, you spend 500 rupees to buy these bonds because in these bonds you will get interest in the future. But now in your pocket there is only 500 rupees. So the amount of money in the system has come down. When you have 500 rupees, you are not going to buy the soap for 30 rupees. Okay, again now the soap for 30 rupees looks expensive. So that is how this central banks and financial policy making looks. Okay, how to manage the money in your hand. So if the government puts more money in the system, people will have more money. Then they will start buying more things. Once you want to control the inflation, the amount of money in the system will be sucked out. Then people will have less money in their hands. Then if the soap is 30 rupees, then no one will buy. So slowly what happens, the soap will come down to 25 rupees. Okay, so inflation will slowly reduce. That is how they will manage. So in this case, 1 and 3 are right. Okay, fiscal deficit is the difference between government's total receipts and total expenditure. Expenditure is more than receipt. That is only called as fiscal deficit. And concept of budget deficit is been discarded long back. And monetized deficit or debt monetization is nothing but purchase of government bonds by the central bank to finance the spending needs of the government. Okay, so consider the following countries. How many of the above countries share their borders with Turkey? Okay, so just look here. This is Turkey. So Turkey is its borders. So Greece also has a border here, right? small border. Greece, Bulgaria, and here you have Georgia, Armenia, and see Turkey is surrounded by Black Sea. So Black Sea means Russia and Ukraine will be there, right? Black Sea. This is Crimea. This is Crimea. This is Ukraine. This is Russia, and also Turkey is the link between Europe and Asia. Okay, remember that Turkey is part in Asia, part in Europe. So it is called as the link between and this Mediterranean Sea. Most of the commercial traffic goes through this Mediterranean Sea, like here the Suez Canal. Okay, so from Europe, all the ships come here through Mediterranean Sea. They pass through the Suez Canal. So here, because they are passing here, they'll pay money to the Egyptian. Okay, whoever. So Suez Canal is a very important channel for global business. And from there, they are going to come here. Okay, the Red Sea. Red Sea slowly they are going to come into Indian Ocean. They are going to come to India, China, all those countries. So Mediterranean Sea is very important, and because Turkey is there, it's very important. Okay, Caspian Sea is, though the name is sea, it is the largest lake, right? The name is sea, but it is a lake actually. It is the largest lake in the whole world. And see Georgia, Armenia, and Azerbaijan. Okay, so Armenia and Azerbaijan are frequently having clashes, frequently in news. Azerbaijan is a Christian country, Armenia is a Muslim country, so that is one of the reasons for the clashes. And Syria, okay, Turkey has border with Syria also. So remember, okay, Greece, Bulgaria, Georgia, Armenia, Azerbaijan, Syria. So let us see. Turkey is a country that occupies unique geographic position, lying partly in Asia and partly in Europe. Okay. So from an economy point of view, from business point of view, Turkey is very important. Okay, and also Turkey is part of NATO. So it's all. I mean, not just geography. Turkey in general, knowing about this region is very important because a lot of the business takes place in this region. So these are the countries. Okay, in the southwest West Mediterranean Sea, Aegean Sea. Okay, here Aegean means usually it will be between Greece and Italy, right? So this is Greece. Where is Italy? This is Italy. So if you've seen the movie Troy, okay, in the Troy, the Greece troops come to Italy to fight a war, right? So they cross the Aegean Sea. And the northwest by Greece, Bulgaria, etc. Okay, the capital is Ankara and its largest city, seaport is Istanbul. Okay, so all these are fine. So what is saying? Georgia, Armenia, Azerbaijan, Iran is not there. Greece is there. So one, two, three, four, four are there, right? So he's saying all five. That means Iran. So we missed Iran. Where is Iran? So if you look here, Iran. Okay, okay. So all this is Iran. The small part is Azerbaijan. So the small part is Azerbaijan. So even this part is Iran. So even Iran is having a border. Fine, Syria. So Georgia, Armenia, Azerbaijan, Iran is there, Greece is there, Bulgaria is there, Greece, Bulgaria, and Syria is there. Okay. So all five are countries sharing borders with Turkey. So consider the following statements regarding GDP and GNP. GDP and GNP are very important concepts. Okay. GDP is basically sum of the total products and services that are produced in the country. Okay, so it does not matter whether it is what I mean, it is produced in the country, it need not necessarily be Indian. Okay, so GDP includes the production, okay, all products and services within a country by producers, citizens, as well as foreign multinational corporations also. Whereas so GDP is gross domestic product, GNP is gross national product, right? Captures all that is produced by the citizens of a country, whether within the geography or abroad. So GDP is geography centric, while GNP is citizen centric. Okay, GDP means whether it is happening within the boundary of India, within the country. That is it. GNP means it is looking at whether it is being produced by Indians. Okay, so GDP focuses on where the output is produced, while GNP shows who produced it. So all these points are very very important because tomorrow a question can be asked. Okay, it will say GDP is geography centric, while GNP is what you say citizen centric, and all these statements. Okay, fine. And also, so China's GDP was much more than its GNP until the last decade. as many foreign MNCs were operating in China. See, it is if you look at the whole world is manufactured in China, literally. Okay, even whether it is Apple, iPhone, or anything, China has a very strong production manufacturing system. So, if you look at GDP means even if foreign nations, even if what do you say, foreign countries or I mean multinational corporations produce, that comes under GNP. Okay, so and China has a very huge GDP, not GNP, GDP. And because, as I said, most of the multinational corporations have their manufacturing base in China. So obviously, GDP will be higher than the GNP. So in this particular case, GDP primarily focuses on where the output is produced, which is true. GDP is geography centric, while GNP is who produced it. That is correct. So in China, GNP was higher than GDP is higher than GDP, GNP. Okay. So only one is the right option. Two is not the right option. So with reference to the Indian economy, which of the following denotes the difference between fiscal deficit and the interest payment? So this is very important. You have what is called as the fiscal deficit, revenue deficit, and primary deficit. These three are very commonly used. So fiscal deficit is total expenditure minus revenue, and from that, if you remove the interest payments, okay, because interest payments is not exactly you're not really spending anything for salaries or capital expenditure, nothing, right? Interest is because you have taken loan in the past, you are repaying that. So if you remove that, okay, then you will get the true picture of how much deficit we are having. So that is why if you remove interest payments from fiscal deficit, that is called as primary deficit. So fiscal deficit minus interest payment is primary deficit. The concept of primary deficit plays a pivotal role in evaluating the government's fiscal prowess by dissecting the fiscal deficit from interest payments. So you remove the interest payments, you get the true picture. It signifies the current fiscal control efforts. So that will show, see, because loans you would have taken long back, long-term loans you would have taken, so you are still paying that. You cannot change it today. Okay, so if you remove the interest payments and see only primary deficit, then you will get a better idea of are you how well are you managing the economy. Okay, so in this particular case, it is primary deficit. Okay, primary deficit is the right answer. It is the difference between the fiscal deficit and the interest payment. That is primary deficit. So a non-banking financial company cannot accept demand deposits. So which is true. Non-banking cannot accept demand deposits unless otherwise the RBI says so. So deposit insurance facility is available for NBFC depositors? No, because in a scheduled commercial banks, for example, there is a deposit insurance facility for them. For example, you are putting 2 lakhs in the bank, okay, and something happens, some huge uh, internet failure or data centers get destroyed, okay, and your money is lost, or the bank some robbery, big robbery happens and your money is lost, then the bank will say they'll go for the insurance. So whatever money you are putting in your account is insured. Okay, so for example, if the insurance limit back then was 1 lakh, it was raised to 5 lakhs. Suppose if you put 5 lakhs in your account, okay, and the bank has insured it for 5 lakhs, so if any big robbery happens or something happens, you will still get back your 5 lakhs because there is a deposit insurance facility. But on the other hand, if you put 10 lakhs and there is only insurance for 5 lakhs, okay, then you will get back your 5 lakhs and 5 lakhs will just vanish. But usually it never happens. Okay, usually under normal circumstances it never happens because the money in the bank is usually safe. But sometimes, very rarely, if the bank winds up, then these things will come into play: deposit, insurance facility, everything. So that is available for scheduled commercial bank. We have already seen in NBFC there is no concept of accepting demand deposits. Okay, basically your savings bank account, your FD account, etc. So when they are not taking deposits, there is no concept of deposit insurance. So two is wrong. And the NBFC is part of the payment and settlement system. No, it is not the part of payment and settlement system, because see, if you are having savings bank account, you are putting 1,000 rupees, taking 500, again putting 10,000, taking 1,000. Okay, all this is happening payment and settlement. But when there is no deposit, what is the use of payment and settlement? So NBFC is not a part of payment and settlement. Okay, a non-banking institution, which is a company and which has its principal business of receiving deposits under any scheme etc., is a non-banking financial company or residuary non-banking financial company. NBFCs have functions akin to that of banks. However, there are few differences. NBFC cannot accept demand deposits, which are payable on demand, like savings and current account. Okay, and deposit insurance facility is not available for NBFC. Okay, next, NBFC is not a part of the payment and settlement system, so it cannot issue checks. Also, try to remember that point. So consider the following regarding deficit financing. We have already seen, right? Deficit financing. So whatever, for example, you have 1,000 rupees, government has 1,000 rupees, but it wants to spend 1,500 rupees. So that 500 rupees deficit is there. How does it spend? By giving out bonds, okay? By making RBI purchase the bonds or giving out government securities, etc. So people will come and buy those bonds because in future government will pay interest, and that 500 rupees is coming to the government. So now it is spending 1,500 rupees. So 500 rupees is getting from the form of borrowing from the public. So deficit financing means generating funds to finance the deficit, which results in excess expenditure or revenue. So which is true. So you have revenue of 1,000 rupees, but you want expenditure of 1,500, so excess. So when you are spending 1,500 rupees, in order to finance that 500 rupees, you are borrowing, generating funds from outside. So the Reserve Bank of India can print money and supply credit in deficit financing. So this 500 rupees which we are talking about, if you want to get, the Reserve Bank of India can print also. So it can print 500 rupees and give it to the government. But usually going through that road, so it is possible. So both one and two are correct. But if the Reserve Bank of India, usually it prints so much money in a financial year. But if it start printing money for everything, then what will happen? The money will lose its value. Okay, suppose it prints 1,000 rupee notes and just pushes into the what is the system. So everybody will have 1,000 rupees in their pocket just like that. And previously they don't have money to buy say a luxury perfume 100 rupees. But now you have 1,000 rupees, you will buy for 100 rupees. So when everyone is buying for 100 rupees, obviously the price of the perfume will become 200 because everyone is buying. So inflation has happened. Okay, the prices are increasing. So when there is surplus money in the system, inflation will people will start buying things and the prices of the items and services will increase. Okay, which results in inflation. So if it is done, printing some money is of course required. But if you go out of control, if you observe what happened in Zimbabwe, okay, back then in Zimbabwe, you had these 5 crore rupee notes. I mean, not rupee, whatever currency, 5 crore notes, okay, lakhs, uh, uh, I mean, crores of rupees of notes. And if you want to drink a tea, you have to take a big bag of money, okay. So why that happens? Because money has lost its value. Okay, inflation is happening. So going for deficit financing can be done by printing money, but that is not a desirable option. Okay. So consider the following events from the first to last. So what happened first? So if you look at first thing, what happened is State Bank of India was established, and when was it established? In 1955. On July 1st, 1955, State Bank of India was constituted under the provisions of State Bank of India Act of 1955. Okay, so before independence, this was called as the Imperial Bank. Okay, before independence, it was called the Imperial Bank of India, which was founded in 1921. After we got independence, it was nationalized and converted into State Bank of India in 1955. Fine. So, Banking Nationalization Act of 1969, very, very important. So, at that time, all this, for example, Andhra Bank was founded by Patabi Sitaramaya, Punjab National Bank was founded by Lala Lajpat Rai. So all these banks were basically private banks. In 1969, under the Indira Gandhi ji Garibi Hatao slogan, all those things, bank nationalization has happened. Why? Because private banks are more concerned about profits. Okay, so they are not going to give you zero bank accounts. They are not going to give you these mudra loans or agriculture loans, all these things. Okay, they may not like to give loans to poor people, banking services to poor people, because private bank means the idea is to make money. Even government banks, they have to generate profits, otherwise they cannot sustain. So Banking Nationalization Act of 1969, total number of the government nationalized a total number of 20 banks. Okay, So 14 banks with deposits worth more than 50 crore are nationalized in 1969. Okay, this 1969 banking nationalization is very important topic. Again, in 1980, one more round of nationalization happened, and this time six banks were and whose deposits were more than 200 were nationalized. All this is very important. First, 1969, 14 banks with more than 50 crores have been nationalized, and again in 1980, six banks with more than 200 were nationalized. So at this time only, all this Punjab National Bank, Union Bank, and all this Andhra Bank, all these banks have been nationalized. So before that, they were private banks. On the basis of recommendation of both Gadkil Study Group and Bankers Committee, okay, Nariman Committee. Reserve Bank of India introduced the lead bank scheme in 1969. The RRBs were the first step, first set up on 1975. Okay, that means during the emergency. Regional rural banks. So these Grameen banks and all these banks, okay, they cater mainly to the rural areas in 1975, and the aim of taking banking services to the doorsteps of rural masses. So now let's go back to the question. So State Bank was established in 1955. So three. Then 1969 nationalization of 14 major banks have happened. That is one thing. And again 1969 December lead this was introduced, and regional rural banks 1975. So 3, 4, 2, 1. Okay, 3, 4, 2, 1. B is the answer. So consider the following statements regarding gross value added and its relation to GDP. So gross value added is GDP plus indirect taxes. No. So let us see. Gross value added is GDP minus indirect taxes. Okay. GDP minus indirect. So see, indirect taxes is something which is, I mean, for example, income tax and corporation tax, all these are direct taxes. But if you go, okay, and have what is a lunch in a restaurant, okay, then you pay the tax. That is indirect taxes. Okay. Now these indirect taxes, they do not exactly reflect how much value is added. So if you remove from the GDP, from the GDP is some total of products and services that have been produced in that particular country. So from that you remove these indirect taxes, then you get the gross value that has been added. Okay, it gives a more truthful measure of the economic product, and the rate of growth as indirect tax collected on a commodity is no way contribution to the growth of economy. Okay, so indirect taxes do not exactly contribute to the growth of economy. So if you are purchasing the product for 100 rupees, that is the true. I mean that 100 rupees worth of product has been produced. These taxes are just extra. Okay. So if you GDP minus indirect taxes, you get the gross value added. A commodity price is known as basic price once its indirect taxes are deducted from its market price. As I'm saying, if you are purchasing what is a soap for 30 rupees, and you are paying total inclusive of taxes 32 rupees. So the actual commodity price is 30 rupees. So this that is called as the base price. Okay, once you add this 2 rupees tax and the sell it at a MRP of 32 rupees, that is called market price. So when the basic prices of goods and produce are added up, it gives the gross value added. Basically, you remove these indirect taxes, then what is remaining is the gross value added. So GVA helps us determine the GDP tax link. Okay, if the GDP growth is not the same as GVA, the discrepancy is caused by tax buoyancy. So basically, remove the indirect taxes, and whatever GVA is increasing, the GDP also should increase. That shows that there is some form of tax buoyancy. Basically, so if you increase, if say there is tax of 10%, okay, and the GDP is 1 lakh. If that okay, and if the GDP is 1 lakh, and because tax is 10%, so if the tax becomes 20%, the GDP has to become, whatever revenue is collected, say is 1 lakh. So if you increase the tax by 20%, the revenue has to be collected, or the GDP produced should be 2 lakhs. Okay, so that proportionality, when you increasing the tax, is the same amount being collected, or the same amount of products and services being produced. Okay, so all that comes as a part of tax buoyancy. So it's basically showing, is it happening proportionately? If it is not happening, that is because of inflation. Okay, so today a product is 100 rupees. Tomorrow the product becomes 120. Then the GDP will increase. But what is the use? So it shouldn't be like that, because today the product is 100 rupees. Tomorrow the GDP suppose is 200 rupees because more number of products have been produced, then that is a good thing. Just because of price increase, okay, you're increasing the prices and GDP is increasing, that is not a good thing. So if the output grows and the tax buoyancy is not commensurate, it may mean one of the following are both. The non-tax part of the GDP is growing, agriculture for example, or there is tax evasion. So, so what it is saying is, if the GDP is growing, okay, if the GDP is growing, but commensurately, that means proportionately, you're not getting the value. Okay, that means it's just there is some form of tax evasion or the non-tax part of the GDP is growing. Okay, so that is not a good thing. So gross value added has to grow commensurately with this GDP also. Okay, so gross value added is GDP plus indirect taxes. Okay, this is wrong. Gross value added is GDP minus indirect taxes. From the GDP, if you remove the indirect taxes, then that is GVA. The basic price of a commodity is calculated after deducting indirect taxes from its market price. So, from the market price, the MRP or whatever, you remove these taxes, then you get the base price of the commodity, which is true. GVA helps us determine the GDP tax link, which is true. Okay, so whatever the tax rate and the GDP, if it is commensurate, then you will say okay, the GVA is also in line. Okay, so GVA, gross value added, helps us determine the GDP and tax link. So only 2 and 3 are the right options. Okay, B is the right option. Fine. So we'll continue with the next class.